Good morning, everyone. How you doing? Welcome to Option Pit. If you're new to Option Pit, this is state of the market. And the state of the market this week is a lot different than the state of the market was 2 weeks ago. Why? If you're from a different place besides Maine, like me, well, I'm not from Maine, but I live here now for forever, it feels like. Write down where you are in the chat. I will answer questions in the last 5 minutes of class. Today, these are the subjects we are going to cover. And I'm also going to tell you how it is applicable to today's market. It's the state of the market, state of the market. So the first thing is, so at the end, we'll dovetail all this together and it'll make sense. So what I want to start with is realize volatility and like how to surf the wave. Again, this will be applicable for my presentation as well on Wednesday evening at 8 p.m., right? Where you understand kind of the basis of what we call a cash collision. But for the first thing is, right, what is realized volatility and why do I care? So the easiest way to describe that is just show you here. So I got a quickie spreadsheet here. So basically what you want to do is, let's pick a stock. And I'm going to pick, because I'm watching Dell lately. Dell's up $2.89 today. So let's see here. So the stock's trading 106.34 minus, it's up 292 today. So yesterday it was 103.42. So yesterday it was 103. And today it's 106.28. So all of a sudden, you get an idea. So you hear this volatility number, you hear VIX, you hear all this stuff, right? Oh, I just filled something. Hold on. What did I sell? Oh, those trading desk VIX puts we paid 110 for yesterday. I just sold them at 3 for people in trading desk. All right. So, hey, almost 200% win. Go us. So, anyway, so the idea of volatility is this. A stock is one price yesterday, and a stock is now a new price today. What you want to do, the whole idea of volatility, is you're trying to quantify that move regardless of the stock price. That's all it is. So volatility is just trying to quantify the move regardless of stock price. That's realized vol. So realized vol is the close to close change in price, regardless of the underlying stock price. So you're trying to do is you're trying to get like, is it a 30 vol move? Is it a 40 vol move? Is it a 50 vol move? It doesn't matter if the stock is 20, 30, 40, or 50, right? The volatility move, this is a one-day volatility move using this formula in the spreadsheet to give you an idea of what that vol is. So basically a 1% per day move is going to be, take a look. All right. So if the stock was yesterday $100 and today it is 101, a one-day move is roughly 16 volatility. There we go. So a one-day move close to close is a 16 volatility. Okay, I'm rounding up here a little bit. So if I have a 2-day move, right? Let's say if it moves what? The underlying moves 2%, which is $2. 100 to 102, that is roughly a 32 volatility, 31.44. So a 2-day move. Okay. Now what we just saw here is we had a roughly 3% move in Dell, right? It was basically what, 103 to 106 to 106. Okay, and again, that's about a 45 volatility. So what you're just trying to get an idea of is how much stocks move close to close. Option traders, now an option trader, liquidity provider, which I used to be when I was, much younger. Oh, now all my alerts are going off and everything, but is why do we use that? Because market makers, liquidity providers use this information, right? They use realized volatility to help price options. So for instance, I'll give you an instance for Dell. So right now, today, you have a 48 volatility move, basically roughly about 3% today, 2.64%. So you know for a one-day move, right? This is our Dell example here. I'll just take this example and I'll give it a little slice here. All right, so remember, I want to demystify the volatility word. All it is a move. I got a price one day, I got a price another day. You throw it into the realized vol calculated, the Garch calculation, and you're going to get a number. So when you see a volatility chart, which I'm going to show you in a minute, that's all it's doing. That's all it's doing. So you know now if the stock is moving at a 45 volatility close to close, how are they pricing the options? So if you want to trade volatility, trade the VIX, trade the vol products, trade anything, you want to have an idea of how much the market's already moving to see how much above or below value these things are trading, because it's giving you an idea how easy it is for your calls to make money. So I'll give you an example here. So right now you have a one-day move of a 45% realized vol. Okay. Now, if the options, right, if the options are priced, so we're going to take a look at a second. If the options are priced at a 35% volatility, and I'll show you where to find that, IV, right? It's easy for them to make money. And this is why you care about volatility. It's very easy when options are cheap, if the realized volatility is high, for the calls you buy or for going up, or the puts you buy are going down, they make money faster. But if the options are, let's say, at a 65%, 65% implied volatility, it's hard for them to make money. From the simple reason is they're too expensive and they're decaying too fast relative to how far you're moving. So right now, Dell options, let's say for June, are priced at a 51 volatility, and I believe it's because of earnings. Okay, so you can see here. So this is live vol, but every platform generally have this little column here, and this is where the options are priced. That's called implied volatility. Just two simple terms here. IV, implied volatility, is how the options are priced. Okay. And you can look at it right here. Okay, you're going to find a column, and you're going to find some column that has IV in this kind of weird number here. So going out to June, because of earnings, volatility is a little higher. Volatility right now for May 23 cycle, which is next week prior to the earnings, is 44. Now, if today the stock just moved 2.68%, and we now know what our volatility is, 45, I would say what I would call these options are fairly priced. They're not a bargain. They're not too expensive. They're not too cheap. They're just fair. And generally with me, my rule, if it's fair, I don't care. Meaning it's not enough. A fair option price in general is not enough for me to initiate a trade. So my little saying here, looking at volatility is, okay, if it's fair, okay, I don't care. So that's really that's the first thing I look at, okay? As a market maker, all we did was talk in terms of volatility price because that told me how easy it was to buy options in general or sell options in general. So what does realized vol tell me? So what we've done is, hey, how much is the stock moving? Now what it does do is how much has the stock been moving over the last 5 days, 10 days, 20 days, 30 days? How many, right? How much has it been moving over the last, how much has it been moving over the last time period? So what this is going to do is it's going to give you an idea of what the market is doing. So you're already getting an idea. So right now, I have a stock here. We have Dell, and we'll give you a little idea of what this looks like. Every platform will have some kind of realized volatility. So here I'm going to give you the last 6 months, and we're going to grab the last 20 days, and we'll see what that looks like. So you can see what happened here. Dell basically the volatility was sky high at 110%. And now 110% probably means something to you. That volatility is roughly double what it is now. So if I go back to this thing, I go, wow, 110%. Like how much is that moving? Like $8 a day. So let's try $8. Let's try 111. Okay, that's 118%. So when I see a volatility that's like, this is what it was, like 110%, this bad boy is moving, right? That's 118 volatility. I know that's an $8 move a day. That's what it's telling me. How much is it moving every day? So when I place a trade and I see 118 volatility average, I'm like, wow, this thing's moving at least $8 a day. So I want to structure my trade, create my trade, however you want to say it. It's going to make money on an $8 move a day. So if you're selling options, credit spreads, whatever, and you're not taking into that account, you're like, whoa, I got a mess. So the whole idea, what does this tell me is like, how much, right? How much is the stock moving? Right? That's why Mark, Leisha, Hans, myself, right? These things all go into our indicators because the first thing you want to see when you have a market moving like this is how much to expect. And then it's much easier to price a trade after that. Now, why is it like a wave to surf? Well, let's take a look. We'll take a little picture here. All right, well, so this is realized vol, all right? It's kind of not doing much here. It falls off a cliff, means the stock basically stopped moving. Then it's not moving at all for a long time. So down here, as a wave to surf, you're basically surfing a flat wave, very, very low vol. All right, it's picking up a little bit, moving more, dying again, picking up a little more, and then skyrocketing here when the stock literally is moving like, $30 in 3 days, moving like 40% over 3-4 days, something like that. And then now what's happened? You see this sense of calm has come back to Dell. Let's look at SPY, right? Now, we had a huge move yesterday, and that's what our little blip here in the screen is. But all of that volatility we just had, again, if we're looking at state of the market today, our volatility has come way down, right? Our 20-day volatility, and granted, it is including some crazy candles here. That's 20 trading days. So there's a lot of stuff going on here. We're down to around a 21 volatility. So how do you use this? The 20-day average volatility is now, let's call it, so this is the average vol every day. Take the last 20 trading days. You just do this thing, right? You just do this thing, but instead of, right now this is 250 due, you're going to divide it by 1/20th of a year instead of every day. You're going to get a new volatility, so that's 22% vol. So that was the market moving around 1.5% per day, a little less than that. But you look at a number like VIX, which is the implied volatility, the SPY, basically, is 17. So the market is already discounting what we've been doing over the last 20 days. So traders are telling you right now, this is the information they're giving you by just reading the screen. All that crap that just happened in the last 20 days, we expect it to slow down. We expect it to slow down. So when implied volatility is trading under the realized vol, okay, this is surfing like a wave, right? When your IV is less than the realized vol, okay, traders expect to slow down. Okay, even more. So if you have VIX puts on, so in the products here at Option Pit, weekly profit cycles, trading desk, we're riding some puts lower. I'm still riding them lower, right? And as the market moves down, I'm taking profits on puts, but my expectation is for VIX to go lower this week. Why? Okay, why is that? Am I inventing some great idea or Andrew's great opinion or my opinion? I've been trading for 35 years. I could be wrong, but all I'm doing is reading what the market's telling me. We just have moved on average 22 vol, and the 30-day volatility, remember VIX is 30 days forward, is 1780. Traders are already discounting what we're doing. So we've had that rally. So you're like, are we going to crash? Are we going to sell off right now? So we're still relatively, like, volatility is right at that halfway point. Remember, for you that came in last week, state of the market, like 18 is kind of the halfway. VIX spends half the time above 18 roughly and half the time below, according to Dr. VIX. So we're kind of right there. So that means 50% of the time we can be lower than 18 and 50% of the time higher. And we're kind of sitting right there at that number, which makes sense for what's going on, right? Trump's saying all this stuff, state of the market. Like, he says something, we have a trade deal, boom, we're up another 1.5%. Any positive news? Inflation was pretty low. Okay. More positive news. Again, slow rally up grinds volatility down. So you can trade a couple ways. You can stay long, right? Buy calendar spreads, maybe buy some calls, because you know that implied volatility, at least for the S&P 500 30 days out, is not too expensive. Just by our little example. Or this is how traders can go short volatility by buying puts in the vol products, VXX puts, go long SVIX, something like that. Where, because even though we've come from like a 60 to an 18, it's what's moving us. Now let's take a look at the last 10 days of volatility. Let's see what we got there. Okay, now this just was 10, jumped to 20 because of yesterday's parabolic move up. We had 2 sharp days up. Realized volatility cuts both ways, up and down. Generally, like yesterday, if you read my F market this morning or last night, we had a very sharp drop in volatility across all strikes in the 30-day options. So this lift we had was not because of the market crashing, because the market crashed up because of good news. Now the good news is out. As far as the China thing, 90-day reprieve, you now have this 90-day window where there's like the news, right, is going to be, okay, we're negotiating. How are traders going to treat that? They're going to treat it by keeping VIX under, or volatility under, where the realized vol is. This wave is now cresting downward for, in my view, realized vol is now cresting downward a little bit. VIX can calm down, maybe get to 16 by the end of the week. Reason why? Strong move up, and all of a sudden we're just coasting up, which is generally a volatility killer. And let me see here. So now here's the next thing here. When IV, right, is greater than realized vol. Now this is a very general guideline. So traders expect things. Expect the market to heat up even more. So IV is pumping over the volatility. Why are they buying it up? Now, again, these are very general guidelines, very general. Okay. So again, when they're paying up for options, generally they're looking for things to move. When they're starting to compress the option prices, sell the option prices down, they're expecting things to slow down, right? Because they want to get ahead of that and make money by, collecting data. How can I trade it? Well, there you go. So trading it is, okay, in general, the implied volatilities, the option prices, right? We'll just call those option prices, gravitate towards, right? Gravitate, move, right? Move towards the realized vol. It's generally how it works. So right now, again, we have a little bit more compression of vol. Now we had, again, this huge rally spiked us, but we had a very long drop in volatility from a very volatile period. Okay, we had basically relief news. Fed spoke last week, CPIs today. What's keeping volatility up, right? So 17 have 18, again, moving about 1% a day. That would not surprise me whatsoever. That's around a 16 VIX. So I would say that's about as low as we have to go. And that gives us kind of our framework for what to trade moving forward. Now, I'll see if we have any questions here. So again, state of the market. Also, I will be showing you how to trade this specifically with Hannah Wednesday night at 8 p.m. Okay. So if you actually want to take this information and put it into a trading program, show up on Wednesday to do that. So today, what are you going to get out of this from let me see, are there any questions? Hello, first timers. How can we get an access to your note? I'll tell you what, if you signed up for this class, we'll send the note. We're going to gussy it up for you, Akashay, and send it to you. With stocks going up, how is it that IV option prices approach realized volatility? So what will happen generally is stocks can go up, right? But what you're getting is, again, the idea, Enzo, is you still have a range. Like the realized volatility is still a number, right? You can still go up, right? So if I go from 103 to 105, okay, that's just a 30 volatility move. Does that answer your question? You can go up or down, and it just creates a volatility, a realized vol, and that's what the chart is. So if we go up 1% a day every day, that's about a 16 vol. Wednesday night is available to option shoppers, Carol, for 100%. Did I answer your question, Enzo? If realized vol is low, remember, it's just one day you're up $2, the next day you're up $2, the next day you're up $2. It's the same volatility, right? So if you go up $2 every day, is realized volatility increasing or decreasing? If I go up $2 every day, is realized volatility increasing or decreasing? Same $2 every day. It's decreasing. So you can steadily rally and realize volatility will slowly crater. So when you're looking at trading, how do you use this today for this market? Is the market we have today the same market that we had 3 weeks ago? Here we were, here we are. We are not the same. Not the same by any stretch. So I will have Christian write this up a little bit so it's a little nicer. I don't know how we can distribute the spreadsheet, but if you want the quickie spreadsheet just to go plug numbers in and get a volatility, we'll try to figure it out. How to make that work, I don't know. But this gives you basically, right? Now, a lot of firms on Wall Street, this is what they use. How do they figure things out? You got to price it first. Got to price it first. So if you're looking at this, can you put the volatility equation in the notes? Yeah, let me just do this. So this is a standard Garch equation here. And here we go. All done. There you go. 30 minutes state of the market. So if you're asking me, where do I think volatility is going this week? Up or down? VIX, where's it going? Up or down? Going lower. Hard to believe, but that's what I think. That's all my positions say. I just keep moving my stops down. There we are. Realized vol, that's as simple as I can explain it. Hopefully, it helped. But tomorrow, Han and I will show you how to use it. 8 o'clock, 8 p.m., be there or be squared. Click on the link above.